What's going on, guys? Welcome back to the channel. In this video here, we're doing a stock analysis on Disney, loading this up in the stock research tool. And with the recent release of Thor: Love and Thunder, I thought it would be much appropriate to analyze this business. So let's go through Disney. I haven't covered this company in quite some time, but let's look at what's going on. So with the company metrics category, let's compare the 5-year averages to the trailing 12 months and see where this company lands and see what they're doing right and doing wrong. It's quite shaky. Look at what's going on. Our 5-year PE average is 51. We're currently up on that with 63.37. Our EPS is currently down from our 5-year average. Our return on equity is also down from our 5-year average, as well as our profit margin. They are getting hit pretty hard. It's not looking too good. They've cut their dividend, it seems. Our average free cash flow is sitting at $5.2 billion, and we're currently sitting at $1.55 billion. Not looking too good for the mouse in the castle. Anyways, 9.63 on a return on invested capital. Trailing 12 months is currently sitting at 33.33%. Sorry, 3.33%. A low Altman Z score, but a decent Piotrowski score. That's one thing that they have going for them, folks, as a redeeming factor. Not too great. We've been somewhat down. I guess their revenues have been getting hit. I don't know. Let's see what the status is on Disney. Let's load this up in the income statement and see what's going on. No, we've been on somewhat of an upswing here. I mean, I don't see why not. They've been crushing it with the MCU. But when you look at the financial evaluation section of my software here of this company, we're grading this a 2 out of 10, folks. That is a terrible score. It's not phenomenal. Terrible score. And what this software looks at, folks, is the cash flow statements, the income statements, as well as the balance sheets to get these numbers. We're scoring this a 2 out of 10. So let's see what they're doing right and what they're doing wrong. So what they are doing right, though, is they had massive EPS growth over the last, 10%. It's still something. They've been growing their EPS over the last 5 years, so it's healthy to see that, as well as the revenue growth has been going up by only 4% over the last 5 years. But everything else is in the red. A high average for our PE ratio. Our current ratio is sitting below 1.5. We don't want to see that. Our return on equity is sitting below 15%. Our debt to equity is 58%, where we want to see this below 50%. They're diluting you with shares. They're issuing out more shares, not by a whole lot, but still nonetheless. Our net income is down. Our free cash flow is down. And our return on invested capital, it's not bad. It's 9.63. I like to see this number over 10%. So 9% is not terrible. Let's look at our net income here, folks, on an annual basis. Like going back as 2017, $8.98 billion, 12 billion in 2018, and then it's just terrible, $2 billion. Oh God. I mean, look, this could all just be pandemic, and it might just be able to bounce back. However, this price has been on a somewhat of a decrease over the last little bit, hitting a low of 91.01 in our 52-week range and a high of 187.58. When I see a price decrease like this, and I feel like this has been a going theme with my videos lately, a lot of these companies have been getting hit hard. They've been falling from these absurd high prices to these low metrics here. So this gets me excited, folks, because when a company price falls, it becomes less risky, and you probably heard me say this a numerous amount of times, but it becomes less risky, as well as it allows us to probably bring in a more fairer evaluation. And if it's a solid business, why not own this business, this great business, at a lower price? Is Disney trading at a fair price? Let's find out. We're going to jump into our price analysis section here, and we'll do an analysis for over 10 years, and we'll fill out these lovely boxes that I have here with these numbers, and I'll touch base with you on that in just a quick second, so stay tuned. Okay, folks, I'm going to show you what I just did here. So with Disney, and if you're liking the video so far, folks, hit that like button, subscribe button for more videos like this. Here's what I did. Try to be as conservative as possible. So with Disney, these are extremely low revenue growth numbers. So with that in mind, I did extremely low revenue growth numbers as well by going 1, 2, and 3. I kept the profit margin and free cash flow margin within a range that I believe that they can hit. So I stuck within their 5-year and 10-year ranges here. So that's why I did 9, 9.5, and 10, with the free cash flow margin sitting at 6, 6.5, and 7. as well as a price to free cash flow sitting at 14, 16, and 18. I know it's a very far cry from 108, as well as our PE ratio sitting at 14, 16, and 18, something a little bit more manageable and something a little bit more realistic. So desired return 13%. Let's hit the calculate button and see what a fair price to pay for Disney would be. I'm not too thrilled based off what I've seen so far over here. So I'm very curious to see what the app calculates for this business. Oh, the suspense is killing me. Oof. All right. So the current price is $92.12. Our average calculation comes out to be $40.32. And you can see here, based off our metrics, 27 for a conservative average, 38 for our moderate, and 54 for our aggressive. So the company has to fall quite a bit, pretty much almost in half, for us to be in that potential buy range, just based off what they've been showing us. And look, and for good reason. Look at what they've done with the company. Look at the financial valuations category here, folks. There's not a lot of green here. To be honest, I would, once this price, if that price gets down here, I will revisit this company and seeing if this has improved. I'm going to give them the benefit of the doubt that COVID and the pandemic has hit them incredibly hard, so they'll eventually bounce back on these numbers here, so that should hopefully show green in the next couple of years or so. However, I would like to see this price fall into a potential $45 range. I mean, if it gets to the 40 range, that'd be much appreciated, because just based off what they've shown us now. But you know what? Maybe I have to retract that statement, because here's the thing: this company has got hit hard. So if the fundamentals improve and I see a lot more green across the board, this price actually might be higher based off what they're showing us. However, if this price continues to fall, it might be worth picking up if I believe that they're going to bounce back quicker. So it depends what happens first. If they start making improvements here on the fundamental side and all these boxes become green again, then it's something to look into. But if the price comes down further, you know what? It might be worth jumping into. This is where the software comes in handy, folks. You can grade it by two things. If you believe that Disney is this solid, let's say, mecca business that, will bounce back, then if the price comes down low enough, yeah, jump into it. But I need this to show green and this to show green first as steps 1 and 2 for me to even consider it. Closing thoughts on Disney. It's currently overpriced. They need to improve their fundamentals first. I want my financial valuation section to be more green. This 2 out of 10 score, not looking too great. However, if that price goes down just low enough and it becomes in a bargain territory, it might be worth picking up. So those are my thoughts. Write down a company you want to see evaluated down below. Write down your thoughts on this evaluation of what you think. Maybe you disagree with me. Maybe you think my revenue growth numbers are too low. And if you want to get your hands on this software, folks, stay tuned. It's coming out as soon as I can get it to you. Trust me, you'll be the first to know. That is the video. I'll see you in the next one.